analysis and interpretation of financial statements. So this unit mainly aims at us understanding how to interpret these financial statements. So for a limited company, it is a prerequisite for them to publish their financial statements in the press for people to analyze and also for informed decisions. We have competitors, of course, who weaken this because they can re-strategize based on your weaknesses. However, it is a requirement that all public limited companies must publish their reports in the media. And now you need to have some basic analytical tools. Now, financial statement analysis basically will help you, the business owners and interested people, to analyze the data from the financial statements. Which statements are we talking about? The income statement, the balance sheet, and the cash flow statement. So these ones will give you an informed decision-making process. And so the purpose of financial statement analysis is mainly to evaluate a firm's performance, a firm's position, also to have a comparative analysis of the company's performance that is within itself, that is intra-company, and between other companies, that is intercompany, and also using the industry averages. So financial statement analysis involves the following. Financial statement analysis involves the following. Number one, it helps provide information about the organization's past performance, present performance, and also about the future performance. So it also helps the organization assess its earning power, the quality, and also the growth. It also helps you ascertain your solvency. Solvency basically is about understanding your ability to meeting your short-term debt obligations. So financial statement analysis is also important because it provides information about business survival. Remember, there are three key reasons why a business must be in place. Number one, for profit making. Number two, for survival. Number three, for market share. So financial statement analysis will provide you information on how this business is breathing. Is it surviving? Or is this business in distress? So this is very important. Then under business survival, we're looking at two key elements. Number one, profitability. Number two, solvency. So these are the key factors that a business will look at. When we're dealing with profitability, we'll be looking at the profitability ratios, how the business is able to generate sales or excess income over the expenses. Solvency will be looking at how the business is able to meet its debt obligations, its financial obligations. So this is basically pertaining to business survival. Financial statement analysis, therefore, to be effective, will have this broader picture. Number one, it will look at internal factors that have to do with the objectives of a firm, the strategy that it's implementing to give the overall health picture of the company. It will also look at the external factors which come from both macro and micro issues. The micro have to do with the industry factors, and the macro have to do with the factors that affect the economy as a whole. These trend from inflation, exchange rates, and other macroeconomical factors that may ever or even emanate from the political influence. So basically, the financial statement analysis gives you a broader picture of this form. Now, we should also understand that financial statement analysis To perform it effectively, you need to be aware of the following. The business strategy. What strategy are we basing our company on? What are the aims and objectives of this institution? Secondly, it will look at the objectives of the firm. On what objectives does this firm thrive on? And finally, the annual report and other documents such as the articles. So this is what we're going to use to do the analysis for, is it Zambian breweries that was given? So we're also going to look at the requirements. So financial statement analysis will require you to understand at least the nature of the industry in which that organization operates. So in our statement, as we do the critical analysis, we need to know which industry that company, Zambian Breweries, operates in. Then also we need to also understand the average performance of the economy as a whole and how it will impact this particular industry. So financial statement analysis is not just about numbers. It is also giving you a broader picture of how the organization is placed in order to evaluate how it's performing, as well as how it's likely to perform in future. So it gives you a report, like we go to the hospital, we want to do a full blood count. So that report should be wholesomely analyzed to seeing how effective your body is performing. So this is what we call a financial statement analysis. So it will give you an overall picture of how the entire institution is operating. So there are a few tools that you need to acquaint yourselves with when dealing with financial statement analysis. There's what we call the financial ratio analysis. A ratio is a comparison of one figure to the other, or from one year to the other. Then the other one will be the comparative financial statement analysis, which will include the horizontal or trend analysis and the vertical or component analysis. So these are the ones that we're going to use in this particular assignment. But of course, for you to appreciate this, we'll start with the ratio analysis. So what is ratio analysis and what is it used for? Ratio analysis is used to compare the performance of a business from one year to the other in terms of, in this case, liquidity. When you're dealing with liquidity, we're practically looking at the ability of the firm to meet its short-term obligations. Under the liquidity, we have two ratios that we're going to discuss, which will start from the current and the quick ratio. The current ratio and the quick ratio. In the profitability, we'll look at how the firm is able to generate excess sales over its expenses. So here we're going to look at 5 key ratios, starting from the GP, which is the gross profit ratio, net profit ratio, the return on assets, return on equity, and return of capital employed. Then we're going to look at the reliance on debt financing. It is very dangerous if a firm is too dependent on debt. So we're going to look at what are called leverage ratios. The leverage ratios give us the dependence that our institutions have towards debt. If it's overfinanced by debt, then it's a risky investment. And so you need to advise the shareholders or would-be investors that this company is dealing with over borrowing. Then also the effectiveness of the management's resource utilization. So if you're going to go back to quiz number 1, we identified a number of users of financial accounting information. So we say these ones will be subdivided into 2 components. Number 1, we talked about the internal users, which stemmed from the managers. These are the people who use the efficiency ratios or activity ratios. So these managers will be held accountable for the utilization of the resources. How are we using the assets in an organization to generating what? Sales. If our assets are buses, to what extent do these contribute to our sales in a company? Then also, we looked at other internal users of accounting information such as the employees. Of course, the employees want to know some basic information on how we are able to pay their wages. Other users of accounting information from the internal spectrum. Who did we talk about? Do you remember the internal users of financial accounting?
The directors.
The directors, yes. So the directors will need to understand this because they're the ones who report this to the what? To the shareholders. So explain the earning per share, how the company is performing, the leverage, how are we financed as a company. Then we also have external users of financial accounting information, who are the lenders. They also want to know your reliance on what? Debt financing, and also your ability to repay what? Your debt. Other users are shareholders, who are the owners of the business. So these ones would also want to be interested in the ratios such as the what? Return on equity. How much dividends am I getting in the investment that I'm putting in this company through my shares? So basically, this unit is interrelated to the first unit because of that. So financial ratio analysis will give you a calculation of ratios using, of course, data from one or two financial statements. Now, a ratio, even in our basic explanation, simply is an expression of relationships between two things. In our case, between financial statements. So these ratios will be categorized in 5 key ratios. Liquidity ratios, which show our ability to meet our short-term obligations. Profitability ratios, which will gauge a company's profitability based on sales or turnover, and also based on the investments in terms of assets. Also, we'll look at what are called efficiency ratios. These are ratios which will look at how efficient you've been utilizing the assets to generate sales. And finally, the leverage ratios, which look at the extent to which we are financed by debt. And also investment ratios, which show the performance of the investment of shares in a company. So these are the ratios that we're going to dominate on under ratio analysis. So they have accompanying formulas that you could wish to know. So under liquidity ratio, we have what we call the current ratio and the quick ratio. The quick ratio is also called the acid test ratio. The current ratio is given by the current assets, you divide by the current liabilities. The quick ratio is given by the current assets divided by the current liabilities, but from the assets, we minus the stock or inventory. When we go to the efficiency ratios, we have the inventory turnover, we have the receivables turnover, we also have the total asset turnover. The inventory turnover simply gives you a picture of how long it takes for us to sell our stock. We know that if we keep stock too much, we are at risk of experiencing costs of warehousing or theft or expiry. So there's a lead time in which you need to keep inventory. So this formula is given by the cost of goods sold divided by the average inventory. The receivables turnover is also called the debtors turnover. It talks about how long our debtors take to pay for the credit sales. So it's given by credit sales divided by the average debtors. Debtors are also called accounts receivable. Then we also have the total asset turnover. It looks at how much sales are contributed to by the total assets. So it's given by sales over the average total assets. Then we also have the leverage ratios. These look at how our firm is able to finance, how much the firm is financed by debt. So under this, we're going to look at what? The debt ratio, which is simply the total liabilities divided by the total assets, and the long-term debt to equity ratio, which is given by long-term debt divided by the owner's equity. And finally, we have our profitability ratios. Of course, there are 5. Here we are just going to be shown 3. I'll explain the others later on. We have the gross profit margin, which is simply gross profit over the profit. Net profit margin is the net profit divided by sales. Gross profit is gross profit divided by the sales or revenue. Net profit margin is simply the net profit divided by the revenue or the sales. The return on equity is simply the net profit divided by the owner's what? The owner's equity. So before we proceed, we'll do a quick can you remember. So we've talked about 5 important ratios that we have. Give me any ratios that we've discussed. Number 1. What are the 5 ratios that we've discussed? Minerva? Sharon? Tamia?
Current ratio.
The current ratio. What do the current ratios do?
You said we divide the current assets by the current liability.
Okay. So it's actually liquidity ratios. So liquidity ratios are 2 types. We have the current ratio and the quick ratio. The current ratio is simply the current assets over current liabilities. The quick ratio is simply the current assets minus stock over the current liabilities. What is the purpose of these ratios? They give us what? A picture of our ability to meet our short-term debt obligations. Which other ratios did we discuss?
Efficiency ratios.
Efficiency ratios. Okay. So efficiency ratios, what do they do? Which other ratios did we talk about? There are 5. Liquidity ratios, efficiency ratios. What else? Anyone else?
Leverage ratios.
Leverage ratios, good. Which other ratios did we look at?
Profitability ratios.
Profitability ratios, good. Which other last ratios did you talk about? Which other ratios? Investment ratios. Profitability ratios look at firm's profitability. We talked about how many ratios? 3. The net profit margin, the gross profit margin, and what? The return on assets. The leverage ratios, what did you talk about?
The debt ratio and is it the liquid?
Yes, and the leverage ratios, we looked at the debt ratio and the long-term to equity ratios. So we talked about the debt ratio being what? The liabilities divided by the assets. The long-term debt to equity ratios, just look at the long-term debts divided by our owner's equity. The efficiency ratios were the turnovers as follows. We had what turnover? The stock turnover, receivables turnover, and what? The total asset turnover.
Total asset.
Inventory turnover looks at how long it will take for us to sell our inventory. The receivables come into 2 ways. There's debtors turnover and creditors turnover. The debtors turnover, debtors are the people who owe us money. Creditors are the people we owe money. So the debtors turnover looks at the time it takes for us to pay our debtors to pay us our money. where the creditor's turnover looks at how long it takes for us to pay our money. All right. So that is what we have looked at so far. So for this, the background is very important for you to appreciate the statement itself. You see the frustrations that we have when we have an X-ray or an FBC and you don't know really what is happening in your body. So this should also be a privilege to understanding the items in this assignment, because you may not really know how to interpret this if you don't understand what the ratios imply, whether an increase, whether the picture is of an improvement or not. So it would be very imperative that firstly we look at what these ratios entail.
Collins, is there an easier way of remembering these ratios?
Well, these ratios will be part of you, don't worry. I'll give you a summary table where everything will be highlighted. So these ratios will be a part of you. This is one of the topics where everything is easier because the formulas are straightforward. So in the evening, we're going to do a question on the ratios. Then we'll appreciate them later on, but they become part of you. Of course, they're a little bit too many, but they're very easy to remember.
Okay.
Don't worry about that. Okay. So far, so good. So now, let me break down what I've already explained. So the liquidity ratio or short-term solvency ratios are there to understand your solvency problems. They are going to help you evaluate the firm's ability to meet its short-term debts as they are due. So the two formulas we talked about is the current ratio, which is current assets over liabilities. Remember, I said that there are other factors you need to take note of, some of which of the factors include what? The industry. So the benchmark for the industry is 2 to 1. So ideally, for every 2 assets, you should have 1 Congole. So the meaning of this is simply we should have more assets, what we own, than what we owe. Is that clear? So
yes.
it measures our short-term debt, short-term solvency problems. Now, the difference between the current ratio and the quick ratio is that the current ratio the quick ratio removes inventory here. When you remove inventory here or stock, it gives you a quick way of solving your solvency problem. For instance, if a creditor comes, I need my money, you not say I have goods. You at least rely on the other assets that you have. So in the current assets, in terms of liquidity, there's cash there. What else? There's bank there, cash at bank. What else? There's a prepayment there, money that you paid in advance. What else? There are what? Debtors. That is your money. And there's stock. So stock, we remove it because this one is what? Not very liquid. So for the quick acid test ratio, the acceptable one is 1 to 1. That is the market rate. So these are the 2 solvency ratios. Any questions before I proceed?
It's fine.
All right, so now we go to the profitability ratios. So profitability ratios look at the firm's solvency issues. So we said profitability is a part of survival and prosperity. So whenever we're dealing with profitability ratios, we're in fact looking at the firm's ability to earn more income over expenses. So a profitable entity will usually cover its expenses. So we want to ensure that this company has more profits, is making more sales than its expenses. But now, JJ. All right, so we can look at the following elements that are involved in the profitability ratios. So the first part is that on focus on the gross profit. So this is what we call the GPM, the gross profit margin. We're just looking at what? The gross profit over sales times 100. So it looks at what? How much sales are contributing to our gross profit. The other one is called the net profit margin. It's simply NPM. NPM. So it is simply the net profit over sales times 100. Then we also have the focus on assets and equity. So we have the return on equity, the return on assets, and also the return on capital employed. So here it looks at the owners of this investment in terms of assets, equity, and capital employed, how much return you're giving them. So these are the profits, profitability ratios. Gross profit margin is gross profit over sales times 100 in percentage. All right. So it looks at the contribution before expenses. But when your expenses are being factored in, we're going to look at the net profit margin. So net profit margin incorporates all the expenses associated with running, but excluding tax. So this is called the net profit before interest and tax, or the operating profit. So the return on assets is simply given by the net profit over the average total assets times 100. So this one shows how much money the company has earned on every quarter invested. So whenever we're dealing with the return on assets, it measures the company's overall earning power or profitability. So the higher the ratio, the greater the return on assets. So this is called our return on assets. Return on equity. Equity is simply the owner's investment through the shareholding. So it indicates the net earnings resulting from the investment of equity. So shareholders here are interested in this ratio because they want to know how much they'll be earning in terms of their investments, which are shares. So this ratio is very important to the shareholders or external users of accounting information because it will allow them to gauge whether the company is creating value or not. So this is how the return on equity structure looks like. You have returns that are coming from operating activities and non-operating activities. So the non-operating activities spread their amounts to financial leverage and spread the amounts coming from operation activities, spread their returns on the net operating assets, which can fall down to profitability, down into profitability analysis, and this one can go down to asset utilization and turnover analysis. Basically, this is the disaggregation of the return on equity. Then we go to what is called the asset management ratios. When we're dealing with asset management ratios, basically, we're looking at how the firm is relating to the usage of its assets. We need to be interested in a firm that has good managers that will make efficient use of the assets to generating what? A specific sales volume. So the asset turnover gives you how much of a quarter of assets contributes to the sales. So the higher the asset turnover, the greater the cash inflow. If you have a lower asset turnover, it means you're not utilizing our assets properly to contribute to the sales. So it is given by sales over total assets. So this ratio is very important because so it's very vital because it will give us a picture of how it also gives us a picture of how the firm is using the assets to generate revenue. It measures management's ability to generate sales from the investments. Generally, it works as follows. If you have a smaller investment being used to generate sales, it means there's more profitability in the company. So a declining ratio may indicate that the firm has overinvested in assets. So sometimes it's not about how many assets that you have. You may have so many assets in an organization, but the ratio of the contribution to the sales is very minimal. For instance, the reason why most of the bus drivers had halted use of when their prices were moderated by government, they looked at this ratio, which is asset management ratio. How much of these buses contribute to sales? And so considering that these assets need maintenance and a dedicated amount for service. So when they looked at the asset management ratios and the contribution to the sales, they declined usage of their equipment. So this is a very important ratio because it gives us a picture of how much sales are coming from the assets that we own. But also under efficiency ratios, a small bracket, which we can call activity ratios, we have the debtors turnover. Our debtors are the people who owe us money. So it measures the time it takes in the year for our trade receivables to be paid. So the higher the debtors turnover, the shorter the period. So also when you are doing an analysis like this one here, you need to marry it with the creditors turnover or payback period. So we should also compare this to the industry level. If you discover that you are paying money too fast, it's also a problem because once the monies are in, they could peradventure to generate more income by buying stock and reselling. So if you have monies and you have a period that you've been given, you need to efficiently utilize that money to make a profit on it, because money sometimes which comes from the sale of stocks that were gotten on credit is as good as money borrowed without an interest. So you also need to be very careful when you're doing an analysis like that one. Same when you're dealing with creditors turnover, it measures the rate at which a company pays off its creditors. So also the higher the creditors turnover, the shorter the time period. So these two, when you're analyzing, sometimes if they take long to pay you, it will also affect the creditors turnover because you're also waiting for monies to be paid. So the creditors turnover is best compared to the industry average. So the lower the ratio, it shows that the company is facing a liquidity problem, or the company has changed the policy in payment of the creditors. So a lower ratio means you're taking too long to pay, but a higher ratio means you're taking a short period to pay. When we go to what is called our stock turnover, which measures the number of times it takes for us to convert our stock into sales. So the higher the ratio, meaning the shorter it takes for us to sell. It is given by the cost of goods sold over the inventory. In terms of days, you may say times 365. So this stock turnover is also best compared to the industry. The faster, the more efficient. So if our stock turnover is high, it means we're taking a short time to sell our stock. So any questions at this point? Any questions at this point? We're clear. All right. So we'll end here for now, then continue later on. But I implore you, because I've sent this slide into your beta group, read through so that as we finish up this, you have the ratios on your fingertips. If you have paid and you're not in the paid up group, please inbox me so that I can add you. I know of just one person here. So we end here.